Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Thanks for listening. February 5, 2026. Talking about what's going on Wall Street, the economy, investing, retirement, financial planning, and much, much more. Let's hit the big headlines. I don't think you're going to like these today if you're thinking about your wealth. The S&P 500 is down 1.3%, down 91 points. Dow Jones Industrial Average down 1.2%, down 619 to 49,000. Still 1,000 points away from the Dow Jones Industrial Average 30's record. It's not too bad. NASDAQ's down roughly 90 basis points, down 200 points, sitting at 22,700. The Russell 2000's down about 1%, sitting down 24 points to 25.99. Bitcoin down $5,300, down 7.2%, sitting at 68,121. It was around 66,000 about an hour ago. So it's well below 70,000. A lot of people think 65,000 to 60,000 may be the short-term area where it pauses to reflect. 10-year Treasury sits at 4.21%. So the headlines are Bitcoin sinks below 70,000 after Bessent rules out crypto bailout. Man, I don't know how America would feel about that. Silver is tumbling, hitting a fresh sell-off in China. I guess I should go through the rest of the market numbers, huh? Silver's down about $11, down 14%, sitting at $72.50. Gold down about 2.3%, down 116 points at $48.34. If I had to choose one or the other, I'd choose gold. Crude oil, Brent crude, is $67.37 a barrel. Copper is slightly lower, not noticeable for most people. Silver is more of an industrial metal, although it is an alternative to gold in markets like India for jewelry when gold becomes too expensive. Now, silver is pretty darn expensive. Oil is declining today after Iran confirms U.S. negotiations are set for tomorrow. OpenAI has launched a platform to manage AI agent coworkers as the push in software as a service comes under attack. Job openings sink to their lowest level since 2020 in a big miss. Is there anything that's positive today? Probably not. With that said, these are the days that I love the most as I have cash ready to deploy and not necessarily in the names that are AI oriented. Maybe. I'll think about that more tonight and tomorrow and bring some of my results to the Pints and Portfolio on Saturday. Snap got upgraded to a buy from neutral with an unchanged price target of about $10. B. Riley sees early signs of progress on a number of Snap's key initiatives. Fubo TV, ticker symbol FUBO, was upgraded to a buy at Seaport Research. Price target of $3. Fubo just posted their first quarter post-merger of Disney's Hulu Live with Fubo TV, and shares fell dramatically. Is there any good news? Doesn't feel like it. Stifel downgraded Microsoft to hold from buy, price target of $392, down from $540, given the well-documented Azure supply issues, coupled with Google's strong Google Cloud platform and Gemini results. Growing Anthropic momentum and a near-term Azure acceleration is unlikely. Susquehanna downgraded Qualcomm to neutral from positive. Price target of 140, down from 210. The firm prefers to move to the sidelines and wait out the memory-related handset storm. Plus, Qualcomm is dealing with modem share losses in Apple phones and a longer spending and design cycle for new markets. Bank of America also downgraded Qualcomm to neutral from buy with a price target of $155, down from $215. Not a lot of downside in Qualcomm, but the question is, what's the upside? Are you putting good money into a dead return for 6 months? The memory issues are not going to play out for at least close to 2028, unless somehow China opens up their market for memory chips. Citi downgraded Six Flags, ticker symbol FUN, FUN, to neutral. That's not fun, Citigroup. Price target goes from 25 down to 20. Citi is saying valuation for the downgrade following the stock's 40% rise off the November lows. Can't say I get all that excited about investing in theme parks. In the past, they've been nice plays on dividends, but not my kind of play. If you pick up what I'm putting down. Let's take a look at the big picture on the market today. We're seeing mega cap stocks under pressure after Alphabet's earnings release. More on that soon today in this segment. Weakness in the broader market. Strength in consumer staples, things that we have to have. Weakness in consumer discretionary, communication services, materials, information technology, energy, real estate, financials, industrials, and healthcare. This is the third day of a sell-off. It is not the 30th day or the 300th day. The market needs a 5 to 10% correction. I wouldn't even mind a 20% bear market. It's been that good of a 3 years on the market. And if you look back at the last 7, it's interesting to note the market's had a good 2019, 2020, 2021, bad 2022. And the S&P 500 returned to growth in 23, 24, 25, and now we're in 26. All of the returns have been outsized in those 7-year periods. Outside on the upside, 6 of the 7 years. Outsized loss on the downside in that 1 year, 2022, tied towards inflation. What our administration wants to do with interest rates spooks me a little bit. It's a spook flag, and it probably takes 3 to 5 spook flags to make my hair stand up in panic. And what do I mean by that? It's a good question. Our government administration, current administration, wants the Federal Reserve to ignore inflation, even though they say they're still waiting for inflation to come a little bit lower. And they want to revitalize growth. That'll send housing prices higher and equity prices higher. It's all out there. And that could, in theory, do the same thing that 2020 and 2021 did when the Federal Reserve lowered interest rates to almost zero. Now, we're not close to almost zero now. And I don't think the new Fed that's going to be starting in 2026 in the second half, I don't think they're thinking we're near pandemic level stimulus needs. But inflation could still come around. And that's the thought. That's the flag, if you will. Stock market has a mega cap problem and a tech stock problem on its hands. Bitcoin has dropped below 70,000 and it's triggered concerns about forced selling. The initial jobless claims hit their highest level since early December. This is not the recipe that you would want per se. We saw a big jump in initial claims, which hit their highest level since early December. That created some headline surprise, but to be fair, the absolute level isn't that bad. The initial jobless claims for the week ending January 31 increased 22,000 to 231,000. That's not a bad number. It's not horrific. Treasuries are perking up, though. 2-year Treasury yield is down 5 basis points to 3.5%. The 10-year sits at down 5 basis points to 4.2%. These moves get their start from the jobless numbers right now. And rock, paper, scissors, we're a little more worried about jobs than we are about earnings. Challenger Gray Christmas report indicated layoffs hit their worst level since January, since 2009. A lot of job cuts there. How do you feel about that? All that? I love hearing your feedback, but I don't get a lot of it. Hopefully I'll get some this weekend at the big event, Pints and Portfolio, Saturday in the East Bay. More on that in a couple minutes. Let's talk about the software as a service apocalypse that's going on right now. You can see names like Salesforce, Adobe, Intuit, LegalZoom. They're tumbling, bumbling, stumbling. Names that are also software oriented like Duolingo and Chegg, they've tanked because AI can do what they do on many levels. Anthropic sparked the big decline, releasing a new legal tool that could usurp traditional legal software and data services. Now, I don't feel bad for the legal software companies and for the legal companies. It's ridiculous if you get a DUI or you run a red light or you want to get a will done and you talk to an attorney? And they're like, absolutely, I'd love to work with you. And then you call back the next day and go, okay, you need information from my wife and my kids, and what else do you need? And then you just realize you got charged 15 minutes at $250 an hour out. Some industries are ripe for disruption. Real estate, for sure, when you're talking about agents, buyers, and sellers. Those commissions and those fees are too high. They've already started to come down, but not fast enough. Legal attorney fees, they're ridiculous. There's someone that my kids, that I video game with, and my kids have video gamed with. They're located around the country, and one of them has got his 5th DUI. Now that's embarrassing, and that's also dangerous to society, and he's going to jail. But his legal fees are almost none because he can't afford them. So he wasn't able to say, anything in his defense or how he's going to do things better. Attorney would have started at $10,000 for a guy who works at Chipotle who makes probably $30,000 a year. So software stocks are collapsing as the AI trade is accelerating. Google's numbers weren't bad, but the fact that they committed so much money for future hardware is spooking people because we want to see the return on investment from the software players. And now we're starting to think, maybe that doesn't happen. OpenAI is committed to taking a lot of the money that is in companies like Microsoft, Alphabet, Amazon's CapEx numbers. And OpenAI suddenly looks weak compared to Gemini with consumers, Anthropic with enterprises, Meta with advertising delivery. Where is OpenAI going to make their numbers? If OpenAI had an email system, you'd say, yeah, they're pretty similar to Google, but they don't. They don't have an operating system. They don't have phones. They don't have the product yet. Now, maybe in the back half of 2026, but that's a long way away. Thus, many questions are coming up right now on who the winners and losers are going to be. The fact that a single well-prompted AI agent can now do the job of 5 or 10 seats does not bode well for the old framework in software. The market is saying that software era is over and the AI is eating everything that stands in its way. I don't know if that's going to be as true and as pure as you would imagine, but it's not the worst. It's not the worst analysis. Let's take a look at some of the numbers. 10-year trail. Brent crude's up 13% for the year. Silver's up 24%. Gold up 15%. That's before today's movement. Bitcoin's down about 20%. The Morgan Stanley Country Index up 1.7%. The Dow Jones Industrial Average up 2.3%, being helped by names like Caterpillar. Apple having a big run recently. S&P 500's up 0.33%, basically giving up the year's gain so far. Google crushed earnings expectations. I'm going to do more on that in the second segment of today's show. Eli Lilly blew past quarterly earnings expectations. It beat Wall Street across the board. A stark contrast to Novo Nordisk, which warned of a sales and profit decline in the year ahead. CEO Lisa Su from AMD said the chipmaker has still seen rising demand and an uptick in its data center business, though the stock fell 17% yesterday. Ouch, ouch, ouch. Oil prices are down 2.5% for the year as fears of escalation between the United States and Iran are subsiding as they're set to meet tomorrow to talk about nuclear weapons. A negative outlook would obviously boost oil. A positive outlook on negotiations would probably pull oil down and maybe sideline it until we get more updates out of Russia and Ukraine, out of OPEC, out of demand for the U.S. economy growth and world economy's growth. So back to that jobs number. Challenger Gray and Christmas said its monthly look at planned layoffs at American companies came in at the highest level since January. Hiring intentions reached their lowest levels since that same period. Ouch. The employment report that was scheduled to come out tomorrow is not going to come out until midweek next week. It's one of the number one things that we're keeping an eye on. You've heard me for years say the first Friday of every month is the one piece of economic data that you have to watch. It's a goofy thing to say out loud, to try to put it into only one thing to watch. I'll stand by that, though, if you only had to watch one. But you don't, but you could. Sony posted earnings that beat expectations despite rising memory costs. The PlayStation, one of the company's flagship products, relies on memory chips. They've been in short supply due to the unprecedented AI demand. This could hurt Sony down the line, but not currently because a lot of those chips were already in place. Take-Two Interactive is still slated to come out with Grand Theft Auto 6 at the end of the year, November. That would drive that stock higher, but at the same time, will it drive sales of Sony PlayStation, and Microsoft Xbox higher if memory chips are up another $100 per unit? Boston Scientific had its biggest single-day decline in 25 years, down 17%. We are seeing really big declines this earnings season. Again, after a stock market that's been up for 3 years and a quarter, I get it. Citi lowered its price target to 102 from 130 on Boston Scientific, ticker symbol BSX. A lot of competition in medical devices that Boston Scientific does well. Johnson & Johnson, Medtronic are big names in medical equipment. I love that medical equipment continues to march forward and that some of those procedures are getting cheaper, because I'm getting to that age where I'm getting older and my ticker may not last forever. What would my ticker symbol be? RB $$. I know you're saying, what would my ticker symbol be? What would your ticker symbol be? BMO. Hiked Eli Lilly's price target to $1,300 from $1,200. Kept a buy rating on the stock. Analysts expect sales in their incretin category to keep rising despite pricing pressures. We've seen some of the GLP-1 pills for no risk go as cheap as $150 for a 1-month supply for your first month. And then there's a secondary price for the second month through 6. But no doubt about it, the teeter-totter on this one, Americans should be losing more weight, should cut down on cardiovascular disease, diabetes, and other diseases like cancer that come along with carrying extra pounds and having heart blockages due to obesity. It's going to be a net positive for society. I would look at Eli Lilly very carefully because prices are coming down, but I would look at it optimistically because of what you see every day. You get on the metro, you get on the BART, you go to Disneyland. Americans are obese. Boeing got an interesting note from Citibank today called the Upside 30-Day Catalyst Watch. So sometime in the next 30 days, they believe that deliveries have dramatically improved. And short term, there's a catalyst around the corner as they continue to report on how they're doing. I'm going to take a break here. I'm going to come back. I'm going to talk Microsoft. I'm going to talk Qualcomm. I'm going to talk Alphabet. I'm going to talk the tech industry. I'm going to talk about the self-driving to survive in software. What China is doing right in electric vehicles, I think, is the real reason that Tesla's pulling back on EVs. I don't think they can compete with China. And that's unfortunate because 5 to 10 years ago is their market to lose, and I think they've lost it. Now, I don't think CEO Elon Musk has done anything wrong for his shareholders per se, but I think he's dropped the EV crown, and I don't think he'll ever get it back while he focuses on SpaceX and XAI going forward. I still have a lot of show left for you today. Before I wrap up the segment, I want to mention Pints and Portfolio. Saturday, February 7th, 12 to 2, Pleasant Hill, California. You can sign up for the event at robblackshow.com. It's a good chance to talk to me about current marketing conditions as well as what I'm buying and selling. Because I will be buying probably very soon. I have to get off this show and do a little research. It's the problem. And a lot of my day goes towards research. But I use most of that research here on this show. I'm going to bring CFP Travis McEuen and Nathan Rogers from EP Wealth Advisors. Going to be in the East Bay for one of 2 appearances for a Pints and Portfolio, Saturday, February 7th from 12 to 2. If you're heading towards retirement, 50 plus, 500,000 to $1 million plus, you want some of your questions answered, this is a great time for you to come. I'm going to bring a mortgage lender as well. An open opportunity to speak directly with financial experts, discuss your questions. Seats are limited, registration's required. I'm going to give you a financial portfolio review afterwards, as well as a preliminary plan, which will give you some insight into how you're doing, what you're doing right, what you're doing wrong. Absolutely complimentary. And I'll even buy the beers on Saturday. So can't wait to see you. It's about 48 plus hours away, Saturday, February 7th, 12 to 2 in Pleasant Hill. Sign up at robblackshow.com. Take a break here. Be right back.
Saturday, February 7th, join Rob Black in Pleasant Hill for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by between noon and 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, February 7th, noon to 2 in Pleasant Hill. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this event in Pleasant Hill and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Let's get another segment in because a lot going on. Some of the losses have been recovered this morning on Wall Street. The S&P 500 is now down 54, down 0.8%. The Dow Jones Industrial Average was down 600 plus. Now it's down 388, down 80 basis points. The NASDAQ down 80 basis points as well, down 189. Cut in its loss in almost half. The Russell 2000 is working higher, but still down 75 basis points, 0.75%. The VIX, the volatility index, is creeping higher, but it's not alarming. It's not panicky. Bitcoin is down $6,000, down 8.2%, sitting at 66,746. That's getting to that level again where it's hitting its intraday low. So worthy of note, Bitcoin trails the S&P 500 and the NASDAQ 100 gold over a 5-year horizon. That's not good. Bitcoin slide is deepening, wiping out the Trump-era gains. CVS Health is going to drop Amgen and Lilly's bone disease treatments from some drug list. I don't own a lot of pharmaceuticals. I don't own any in particular other than in S&P 500 funds. This weekend is going to be another cold blast gripping the Northeast, testing power demand. Alphabet's down about 3% after reporting expectations to spend $180 billion for 2026, which is a massive AI bet. Can you imagine if they were giving that to shareholders? That would be a different stock move of the day, if you will. But they're not planning to give it to shareholders. Let's talk about Google and their report last night. Their CapEx in 2026 is poised to smash expectations. Broadcom's a big winner, but I'm getting ahead of myself. Alphabet's price target hikes from Wall Street analysts after an incredible quarter. An unappreciated boon to Alphabet is the cash tax benefits from the Trump-supported One Big Beautiful Bill Act. Management guided to massive 2026 spending, but let's go back to that Trump-supported One Big Beautiful Bill. Money put into CapEx is going to be able to be written off faster, thus creating more tax headwinds for companies like Alphabet. I think they had a really, really nice quarter. When you look at it, there was just a lot of things to like in their quarter, including YouTube. Is it something I want you to pursue and chase and buy today on a dip? No, I want you to have a better strategy than chasing and pursuing because you think you have to. The Google Cloud division had $17.66 billion in revenue. The overall company had $113 billion. A lot of money still coming in from search and advertising. YouTube advertising hit $11.3 billion in revenue versus expectations of $11.8 billion. So a little bit of weakness there. But that CapEx expenditure of $175 to $185 billion was more than double the 2025, more than most people thought. Barclays said in a note today that infrastructure, DeepMind, and Waymo cost weighed on overall Alphabet profitability and it's going to continue to do so in 2026. With that said, I would expect some of those costs to start trickling more down to the bottom line. Infrastructure costs should help with search. DeepMind should help with AI, and Waymo should help with an IPO probably in late 2026 or 2027. They announced they're going to 2 more markets today, including Sacramento. They're becoming quite embedded in our society and expected. Deutsche Bank analysts said today that Alphabet has stunned the world with its huge CapEx spending. With tech in a current state of flux, it's not clear whether that's a good thing or a bad thing. That's kind of a funny statement to make, because I don't necessarily disagree with it. At some point in time, we'd like to see the bottom line more attractive, or more companies like software companies like Adobe, Microsoft, Intuit, Chegg. You get the idea. Salesforce say, not only is it working great for us, but it's hitting our bottom line hugely. And our productivity is going way higher. Now, the productivity we're seeing in national numbers, it's just tougher to quantify in software per se, or the hyperscalers. So Alphabet released earnings yesterday. Things are looking pretty solid. They've been riding high following the widely praised release of Gemini 3 back in November. Growing enthusiasm around its lucrative tensor processing unit TPUs. A lot of that billions of dollars in market cap is going to be used to buy in semiconductors, which benefits Broadcom. So Broadcom's up bigly compared to Google. YouTube's ad revenue rose 9% to $11.4 billion. Google Cloud revenue for the fourth quarter was $17.7 billion. That's up 48% year over year. It's an astonishing rate of growth. Google's search business brought in $63.1 billion. That's up 17%. Google's advertising revenue was $82.3 billion, a 14% increase year over year. It was my stock of the year last year. I'm thrilled with it. I still own it. I'm not going to let go of it. It's turning into a large position of mine, as Microsoft did, as Apple did, as Nvidia did when I chose not to sell them into strength. Why does Google spend so much money? As my old boss used to say, do-re-mi. Ultimately, because it can't keep up with demand due to constraints on its compute capacity. CEO Sundar Pichai was asked what keeps him up at night, and he said the ability to deliver compute capacity. Cloud computing demand is surging. Google simply can't fulfill all the orders that it has. It can't build the data centers and AI infrastructure fast enough. There's a lot of questions on, will we build as much in data centers and energy that supplies those data centers? What's going to come first, the energy and or the data centers? What level is going to be completed versus what's promised? Questions are coming up. The technology is no longer golly gee whiz cool. It's now, where does the profitability come? How much debt do companies take on? How much cash flow do they sacrifice? Why isn't Google giving me $175 to $185 billion for being a shareholder versus investing in their future? Analysts, just to show you how big this number is, $175 billion. Analysts were expecting $115 billion. So that's an extra $60 billion plus dollars. Broadcom has enjoyed a halo effect from Google's CapEx plans. They have to be the biggest winner here. So who knew that customers needed so much? There wasn't a lot of customer announcements here. Not a lot of new customer announcements. And Wall Street wants those new customer announcements. That's maybe why one of the reasons why the stock's a little bit lower. But the number is just huge, too. $175 billion for 1 year of buying hardware, infrastructure. So Google has a supercharged spending plan. They're nearly doubling its capital expenditures this year. What the analysts had to say about it, let me share with you. Gemini's halo effect is shining bright, so says Bank of America, arguing that agentic capabilities and monetization of the Gemini app, 750 million monthly active users, up from 650 million last quarter. Advertising and revenue catalysts are ahead. Analysts are citing the record at Google search usage as evidence that AI is driving an expansionary cycle. So Meta has already showed us that AI is helping with their ads. Google's starting to show us the same thing. Bank of America said, we continue to see opportunity for better monetization of zero-click searches that are being converted to OI overviews as a key upside driver from here. Morgan Stanley talked about Alphabet. Similarly bullish tone, arguing that Google's accelerated revenue and sharply higher capital spending are reinforcing the advantages of the largest tech platforms. Search revenue is up 17% year over year. Google Cloud grew 48%, far ahead of expectations. Current backlog jumped 55% quarter over quarter to roughly $240 billion. All this love for Alphabet, not all the love for Microsoft's Azure. Alphabet nearly doubled capital spending. Morningstar called the mammoth plan a vote of confidence in AI demand, leading to more investment in revenue, generating opportunities from search, cloud, and agentic use cases. Dan Ives, who's never met a tech stock that he didn't like, I don't think he has. He raised Alphabet's price target at 370 buckaroos, citing strong fourth quarter results that reinforce the company's position as a leading AI beneficiary. Let's move on. Stifel downgraded Microsoft to hold today from buy. They believe street expectations for revenue and earnings per share are too optimistic given the well-documented Azure supply issues, coupled with Google's strong Gemini results and cloud services. On the spending front, they've increased their 2027 CapEx estimates to $200 billion, which is 40% growth and in line with Google's updated $180 billion. Tremendous operating expenses discipline for companies like Microsoft seems to be going out the window for some analysts. Good times, huh? Qualcomm got a downgrade from Bank of America Securities to neutral from buy. Price target goes from 215 to 155. They're looking at 13 times 2027 PE versus 17 times. They're lowering the multiple based on a combination of cyclical and structural weakness of handsets, problems getting memory cheap enough to put into their products. Overall, tech is getting murder-related today. Not as bad as it was an hour ago, but the iShares expanded tech software sector, ticker symbol IGV, is down 2.9%, double what the market is. Supermicro is down 12%, the weakest performer in the sector. Qualcomm's down 9.2%. Palantir down 7%, fallen to its lowest level since July. Dell's down 6%, fallen to its January low of 110. It's at 114 now. Enphase gave back some of the gains from yesterday. Datadog, woof, woof, down 6%. Microsoft down another 3.5%. It's a broad-based bloodbath again for software. NVIDIA is down about 1%. Company's next gaming GPU will be delayed due to chip shortages. Company warned that the Trump administration that China-related export rules are too strict. Apple's just down fractions. They kind of didn't really go full in on the AI world. Therefore, they're benefiting from it. And with Google's massive spend, they're probably going to benefit from that. Google Gemini jump to Apple AI's provider from it. The only stock I see really up today, too, Teradyne, reclaiming some of yesterday's loss, and Broadcom up 1.8%, bouncing off its 200-day moving average. They're benefiting from all that Google's doing on spend. NIO is projecting its first quarterly profit. It's a Chinese electric vehicle maker. If you go YouTube, China's top 5 EVs, they're pretty damn impressive. They make Teslas look silly. They make everything the United States has to offer wrong. They're not allowed in the United States. You have to go to Canada to buy one. I almost want one. That's how attractive some of these YouTube videos are showing their products to be. And they're affordable. They're premium priced, but to get the same level of packaging from a US made vehicle, it'd be $400,000 versus $150,000. Let's talk real quick about hyperscalers like Amazon. Tonight, Amazon's going to report how much CapEx is too much. Alphabet's reported. Microsoft has reported. Meta has reported. Much larger than expected CapEx in their reports. Now, Microsoft and Meta got different feedback than, say, maybe Amazon will. We don't know. Microsoft and Oracle have been making their investments based in part on growing demand from privately held AI companies. Microsoft got into some trouble when we learned that 45% of its remaining performance obligations, which is a measure of backlog, is coming from OpenAI. Google doesn't have that problem. Software's meltdown. I read this article in Barron's, and I just thought it was so fun, and I wish I would have come up with it. Tying the software pullback we've recently seen, which I own none of those stocks directly. Of course, I own them in S&P 500 and growth funds, but I'm not changing what I'm doing based on that. But a Barron's author named Michael Nagel, I'm going to give him all the credit in the world. He started talking about software and how should we be approaching it as an investment. And he says, think back to George Orwell's 1984, believing two contradictory ideas at the same time, which is what's known as a theme of George Orwell's 1984, called doublethink. And it's what Wall Street is doing right now. In the article, posited the idea that investors are transitioning from mega cap tech giants on concerns over the pace of AI spending, but they're buying stocks of companies that rely on input cost of soaring commodity prices to maintain their profit margins. Anthropic released a new AI-powered add-on that could render software obsolete, is the thought. It's not necessarily my thought, but it's the thought on Wall Street right now. It's what money is voting with. Do we really think software will become obsolete while continuing to question the pace at which companies are adopting the new technology? Slower than expected, we're upset, but then software is going to get obliterated. Are they both right? Now, a year ago, right around this time, DeepSeek created a meltdown with the launch of a cut-priced AI chatbot, which spooked investors that had piled into U.S. tech AI plays. AI adoption will be so pervasive and productivity enhancing that software becomes obsolete. It's the thought, but China was able to say, hey, we came up with a large language model that's better or as good as many of the US-based models at a fraction of the cost. So why are American companies spending so much? A year ago, things sold off and they recovered, but that sell-off scarred a lot of people, especially since it was so close to the April tariff tantrum that President Trump's administration induced with that silly chart of how much in tariffs countries are going to be paying, of which none of them are paying that. But it was a scary looking chart for a lot of people. Capital Economics' James Riley sees a way out of the market contraction, arguing that decline in software stocks is more closely tied to company specifics than sector skepticism. I don't follow a lot of the software companies directly. I'll do a little bit more work this weekend. Oracle's now 53% south of its 52-week high. CoreWeave is down 51%. Salesforce down 45%. Workday and Adobe down 42%. Duolingo is down more than 78% from its May 2025 peak. One of the analysts quoted in the article remains optimistic that investors will see the thread that ties AI capex, which Gartner estimates will reach $2.5 trillion total this year, and that investors might see that tie to widespread adoption. Can we have the double plus good that Orwell spoke of when talking about doublethink, where two things can both be true, even though they're contradictory? I want to say goodbye to orange juice pulp. It's something that my family used to buy. Those little tubes, if you will, of orange juice that was frozen in the grocery store. It's been 80 years of that stuff. If you prefer your OJ still a little bit frozen with a slight metallic tang, go out and buy the cartons now, because after 80 years, Minute Maid is discontinuing its canned frozen juice concentrates in the US and Canada. All 5 flavors, orange juice, lemonade, limeade, pink lemonade, and raspberry lemonade, are going to disappear from store shelves once they sell out. The story of frozen juice has a great backstory. Back 80 years ago, we invented frozen orange juice. And when my first child was born, I went out and bought some frozen orange juice just in case we needed it for whatever reason. It was nice to have around. Now it's going bye. So the U.S. Army once needed 500,000 pounds of orange juice in 1945. They ordered it from a company called Florida Foods. The war ended before it could be delivered. The company made it commercially available to the public in 1946 as Minute Maid. It caught on. Minute Maid brand was bought in 1960 by Coca-Cola, trying to be a beverage company instead of just a soda company. It didn't bring out non-frozen juice under its banner until 1973. Consumer taste have shifted away from that frozen slushy orange product. Coca-Cola said it was shifting its focus to what people actually want. But there is an outpouring of love and nostalgia for the canned stuff. And I totally get it. So earlier I incorrectly said that Hims is going to offer copies of the Wegovy pill at $149 a month. It's actually $49 a month for the starting dose. Now, again, that goes away after 1 month. And it's going to change to $99 a month versus what Novo Nordisk charges for the patented version of $199. We'll talk about that in the future. I know. Big event this weekend. I hope you sign up because attendance is a little low, which is great because it'll be private and intimate. It's about half full. We can deal with another 3 or 4 people for sure. Pints and Portfolio, Saturday, February 7th, 12 to 2, Pleasant Hill, California. Sip, socialize, and get your financial questions answered. CEFP Travis McEuen, CFP Nathan Rogers are going to be there. It's a good event. You get a complimentary portfolio review and a preliminary financial plan. That's probably about $500 to $600 of free work that Travis and Nathan are going to do for you. After the events get to know each other, chat about your questions, talk about stocks, talk about investing. No question is weird. I like these events. They're incredibly informal, and that's the way you should approach financial planning. You should learn a little bit something about it. Like Christian McCaffrey just spoke to a group of high schoolers, and he said, when I was your age, we didn't have this. I love that one of the teenagers asked, how did you spend your first $1 million? He goes, I didn't. I just loved playing football, so I just saved it. I like that. We need to talk more openly about money, more openly about sex, more openly about sexuality, more openly about politics. We should not get mad at each other. We're all going to die. We live on this planet working together. Let's do some financial planning together, please. This week in Pleasant Hill, California, Saturday, February 7th, 12 to 2. Sign up for Pints and Portfolio at robblackshow.com. Hope to see you in Pleasant Hill. This afternoon, I'm going to have another podcast for you and talking about Amazon. The podcast is New Focus on Wealth. Find it where you find podcasts.
Saturday, February 7th, join Rob Black in Pleasant Hill for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500,000 or more in investable assets. Drop by Saturday from noon to 2 p.m. in Pleasant Hill for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or are already there, this financial snapshot can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. Go to robblackshow.com and click the events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide you all the details on the location of the event in Pleasant Hill and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Saturday, February 7th in Pleasant Hill, noon to 2 p.m.